Hi, my name is Seanagh Fannin and I'm a director at Carrick Athena. This episode we bring you today is probably one of the most important elements to understand in the investment world. What is a return and how does it work for you? Now, I know that some of you are more sophisticated investors than others and some of you are just starting out, but this is something that crops up all the time. Clients not really knowing what returns they're getting or how to assess if they're good enough, and really how to make sure that returns are working for them. In aiming to close the investment gap and make sure that women are getting invested, we realize that many women feel like imposters when it comes to investing. Because traditionally, for whatever reason, we weren't the individuals who were making those decisions. But as discussed in part one of this series, it really is important to, firstly, have control of your own money, get invested so that your money works for you, and get started on this journey immediately. The fact is, 74% of women die single. That means that regardless of your current family structure, at some point you will be in control of the family finances. Knowing what structures are in place and why is absolutely essential. Understanding the effects of debt, how your marital regime impacts you, and the various elements that inherently erode returns on investments is absolutely critical. In part one of the series, we looked at how to achieve financial freedom. And here's a quick reminder. In part one, I suggested to you that you imagine all of your assets in a bag of wealth, everything you own, your property, your finances, your investments. And if you invested that bag of wealth at a specific return, let's say 10%, and it managed to generate enough money for you to live off on a monthly basis, if you could make that very simple story work, then you would be financially free. Today we look at the returns portion of that little equation, what they are and what affects them. So what is a return? A return is the amount that your money will earn. It is usually defined as an interest rate. So if you have your money invested in a savings account at the bank, and the bank is giving you a 10% return, then this would mean that your funds would earn 10% more. For example, if you have 1,000 Rand and I've given you a 10% return, that means by the end of the year, you're going to have earned 100 Rand on your initial investment of 1,000 Rand. Again, I know that there are sophisticated investors who are watching this and there are new people who are coming to investments and starting out, but you'll see in a moment just why this crops up all the time, where people don't actually understand what their returns are. So stick with me. If you're finding this too low level, hang in there. Normally, a return is expressed as an annual amount. So if the bank says to you, you're getting 10%, then you're earning 10% per year, not 10% per day. It changes things. So why is a return so important? And how do we make 12 million Rand out of just 3 million? Because the return is what generates the effects of money compounding and working for you. How this works is the key to investing, and also why the sooner you start investing, the better. Compound interest. So let's go back to our example. I said to you, if you have 1,000 Rand in the bank and my investment is generating a 10% return per month, then by the end of the year, I'm going to have earned 100 Rand. Great. So at the start of the new year, I'm going to have my initial investment of 1,000 Rand plus the money I've earned. I've got 1,100 Rand at the start of year 2. Excellent. Now the bank has still said to me that they're going to be giving me 10% for that year. So at the start of the year, I've got 1,100 Rand. I earn 10% on that 1,100 Rand. Instead of just earning 100 Rand like I did last year, I've earned 110 Rand this year. So at the end of year 2, I now have 1,100 plus 110 Rand that I earned this year gives me a total of 1,210. Don't let me lose you in the figures. What's important here is that your interest that you earned last year is now generating interest, and that's compounding. The start of year 3, I now have 1,210 Rand. I'm still earning 10% interest. This means I make 121 Rand on my investment for the year. Instead of like in year 1, I only earned 100, this year I'm earning 121. So at the end of the year, I have 1,210 plus 121 gives me 1,331 Rand in the bank. If I had to extrapolate this example and use R1 million as my initial investment, what would that mean? It would mean that by the end of year 3, I would have earned 331,000 Rand without doing anything at all. This is called compound interest. And although you might be saying to yourself, too many numbers, it's not really my thing, just go back and work through the example because it really follows on quite logically. Ask us if you still don't understand, because the effects of compound interest is your ticket to building real wealth. It's the reason you will start to consider on a daily basis what you spend your money on. A cafe latte, a pair of shoes, an overseas holiday, or putting money into an investment as fast as you possibly can, as soon as you possibly can, to benefit from the effects of compound interest. So if you look at this table assumes that you are investing 16,000 Rand per month over 12 months. 16,000 times 12 means that I'm investing 192,000 Rand a year. Great. If I had to get 10% growth on this every year and do this for 20 years, at the end of 20 years, I would personally have only invested 3.8 million. That's all I would have put in. That's still a vast sum of money, don't get me wrong. But because of the effects of compound interest, that investment would now be worth 3 times as much as what I had actually invested. It would be sitting just under 12.2 million Rand. So yes, it does count that you save and bank your pennies as soon as possible. Yes, it does matter that you're putting a tiny amount away of your savings for your future every day. Is it worth saving a small amount each month for your children over 18 years before they leave school? Absolutely. It's actually imperative. So that's compound interest, a really, really, really important element to understand. Why is it important to understand the percentage that you're achieving? So maximizing your returns and getting the most out of an investment is essential. It's not so much about how much you are earning on a month-to-month basis. For example, so many clients say to me, yes, but my investment is doing great. It went from 110,000 or 100,000 to 110,000. It's growing. It must be doing wonderfully well. It's not so much about that Rand figure. It's more important to consider what that percentage return is. And most of my clients, whether they're sophisticated or beginner investors, simply don't know how big a percentage they're earning on a return. So why is it important to understand the percentage that you're achieving? Because as you can see, in the compound interest example, although the amount of money was growing, the return that was being achieved was remaining the same. The bank account was only ever earning 10% per annum. So if you're looking at your investments and going, well, they must be doing well, they've gone from 100,000 to 110,000, you can't actually be sure. You don't actually know whether that percentage interest is good enough. Imagine in that compounding interest example, if we'd been able to increase the return to 20% per annum, then your funds would have hit 12 million Rand after just 12 years rather than 20 years. So it's really important to understand how big a percentage you're earning in terms of a return. Fine. What is a good return? How do I know if what I'm achieving is actually good enough? Let's assume that you do know what percentage return your investments are earning. How do you determine if it's good enough? An easy way to think of this is to start with a basic and very easy to achieve return. This would be around 5%, and this is something you can get from putting your funds into a bank savings account. Very straightforward. It's your starting point. It's your go-to point every time you think about returns and trying to conceptualize whether what you're earning is sufficient. In the world of investing, 5% is considered to be a cautious return. South African banks tend to give higher interest rates on returns than offshore banks. There are a number of reasons as to why this may be, but offshore banks will probably only give you between 1% and 2%, if you're lucky. So offshore investments in hard currency, like sterling or dollars or euros, have lower returns, and I'll explain to you why that is in just a second. But don't be confused if you look at your offshore bank account and see it's only doing 1%, that's perfectly fine. The important part that I want you to remember here is what is your starting point? What is my baseline that I must be earning? 5% in South Africa or 1 or 2% offshore? So if you're getting a 5% return at a bank, anything above this is going to be considered slightly less cautious. In South Africa, if you're getting a return of 10% or higher, this is considered to be very good and a growth-orientated return. So what does this mean? Well, it means that you're more likely to be subject to market volatility. As your returns go up, it means that you're probably investing in companies that are invested in more equity, and so they're probably a little bit more volatile than just holding funds in the bank. You get your higher returns from more volatility, and you don't need to be scared of that. The rule is time in the market solves everything. So when you're creating a portfolio, as we'll discuss in a future episode, you split your portfolio up into cautious, balanced, and growth. For the moment, I just want us to focus on what is a good return. So what 4 things must I take into account when I'm looking at a return? We've already decided that we understand compound interest. The more money you invest and the sooner at a specific return will grow your funds that much faster. Now we need to make sure that there's nothing that's taking away from that return and that what you're actually achieving is what you're coming out with. This really applies to all investments, whatever they are, whether you're a beginner or a sophisticated investor. You always need to be evaluating your returns on the following 4 factors. And when I say in all investments, South Africans are generally quite strong in property. When you're looking at property as an investment, not your home, anything else. If it's an investment, you need to be assessing it against the following 4 elements. Element number 1, fees. Mostly when returns are quoted with regards to funds and portfolios, this is done after all fees have been considered. But it is important to check. Why? Because if I'm giving you a return of 8%, but the fees are actually 6%, then you're only coming out with 2%. 8 minus 6 gives me 2. That's logical. And when we go back to that initial return that I was talking about, that 5% bank return, well, 2% is a lot lower. So this is not a great investment. It's a bit rubbish. Element number 1, make sure that your returns are quoted after fees. Element number 2, rand depreciation. This is a tricky one, but it's absolutely vital that you take it into account. The truth is, we live in an amazing country. It just so happens that it's at the bottom of the world where the lights keep going off. We export and import absolutely everything. If you look around where you are right now, everything is imported. So we need to make sure that we can keep up with the cost of those things that we're importing from developed markets like Europe or the States or wherever it is. The rand is only supposed to depreciate, lose value, by about 6% a year. So I want to just take us back to our baseline starting point. Remember, our savings account was 5%, and we said that's where we're starting. If our baseline is 5% and the rand is losing 6% a year, we are not quite where we need to be. We're actually coming out in negative. It just so happens, and the fact is, that the rand lost 24% last year. There is literally no safe and cautious investment I can advise you to invest in that would yield you 24%. I would have to potentially put all of your savings into something like Bitcoin, which is fine, but it's too risky for a whole bank of savings. So if you're wanting to be cautious and invest cleverly, get your money offshore. We just cannot keep up with the rate of the rand and its depreciation in South Africa. The next item to consider is inflation. Inflation in South Africa over an historic 10-year basis is about 6% a year. With load shedding, it's probably much, much higher than that. But the government aims at it being around 6% a year. So again, remember going back to our savings account, which is giving us a 5% return a year. If inflation is 6%, we're falling behind a little bit. Again, it's below its target. So we need to make sure that our wealth is not just invested in a savings account, that it's invested in something that's growing faster than inflation, at the very least. And the last item to consider is taxation. South Africa has an incredibly advanced tax system. And when you're measuring your returns, you must calculate the effects of taxation. If you don't, then you could well be falling behind your target. So to summarize, simply put, what do I need to take into account when I'm considering my returns? I need to take into account fees, I need to take into account rand depreciation, inflation, and finally taxation. And after all of these things, am I still achieving a positive figure on my investment? If I am, then I have a good investment, then I have a really good return. And if after all of those things, I look at my compound interest table and see that I'm still achieving my goal, then I've got a great investment. Hint: you cannot achieve this by only investing in South Africa, regardless of the investment. If it is a actual liquid investments, what I mean by that is cash that you can invest in quickly and change very quickly, or even if it is property, it remains an investment, and the above factors will definitely apply. So we've understood compound interest, we've understood what a good return is, we've understood the factors that erode returns. Where do we go next? Well, women and investing, and what do we tend to do? As I said at the beginning, most women really doubt their ability to make financial decisions. So what tends to happen is they hold all of their savings in a bank account, otherwise known as a money market account, with the thought of, well, at least it's earning something. So let's assume the bank account is giving us 5%, as I've given the example previously. Now we take off inflation. 5% minus 6% is giving me minus 1%. Now we take off rand depreciation, another 24%. Before we've done anything, this investment is losing 25% a year. A quarter of its value every single year. And that's before we've even considered taxes. Understand this little equation and you will start to make very sound financial decisions. The whole financial services industry is based on this equation. So I'm going to go back to it. I have my bag of wealth and it's invested at a certain return that's generating me enough income for me to live off every single month. If I can achieve that, and this return is a positive return, in other words, it's taken into account inflation and rand depreciation and taxation, and I'm still coming out positive, and it's still generating me enough money to live off. If I can achieve that, then I'm going to be financially free. And the whole financial services industry looks at ways and means to achieve this equation, to decrease the expenses on your return, to maximize the bag of wealth that you've got, and to make sure that you've got enough money from month to month. Just a quick recap of what we've discussed so far today. We've discussed what is a return, how to turn 3 million rand into 12 million rand, why it is important to understand what percentage return you are receiving, and what is a good return. And then finally, what are the 4 factors you must consider when looking at returns? Remember what we're trying to do here. We're trying to reach our life goals as soon as possible. In our next series, we'll be looking at how to know how much you need to save. And we're going to be looking at the rule of 50%, 30%, 20%. Know that you're not alone in this journey, and we're here to help you every step of the way. Save, grow, live. Carrick Athena, a wealth advisory for women, by women.